Hi everyone, I'm John Zaller, CIO of MAI Capital, here with the latest edition of the MAI Market Update. This month, I'm happy to be joined by Jeff Stark, Managing Director and Senior Portfolio Manager on MAI's investment team. In addition to working with clients on their portfolios and leading our manager research team, Jeff is also responsible for delivering the State of the Union on U.S. economic data every week to our investment committee. I'm grateful to have Jeff on today to discuss the current economic environment and its impact on markets in 2024. Jeff, thanks so much for joining me.
Thanks, John. Great to be here.
Well, Jeff, it's certainly been a tough few years to be an economist. How did we get to where we are today?
Well, I think we need to go back to COVID to set the stage. COVID provided the perfect environment for inflation, with both stimulus programs increasing demand for goods and manufacturing or shipping delays reducing the supply of goods. This took inflation up significantly, and the CPI ultimately peaked at 9.1% year over year in the summer of 2022. Of course, the Federal Reserve has a mandate to keep prices stable and to fight this inflation. From February of 2022 to July of 2023, they increased the target rate by over 5%, from effectively zero to a 5.25% target. Along with other factors, this aggressive policy helped to bring inflation down to the 3% range by June of 2023. And even though inflation fears eased a bit, the aggressive Fed actions meant that for much of 2023, market participants were worried about a possible recession, as past tightening cycles have often done.
Yeah, I think we've all been waiting for the proverbial shoe to drop, but thus far it hasn't happened. So where do you see us going from here? Is recession still a risk for the markets?
Well, to start 2024, the script has flipped a bit. Macroeconomic data has largely stamped out the recession fears that loomed over 2023, but inflation has become a concern again. Um, the unemployment rate has remained below 4%. Job openings are off their highs, but elevated versus history. And the consumer is still spending. Retail sales were up 0.7% in March, beating expectations. You also have the conference board's leading economic indicators no longer signaling a recession. I think the market rally that you saw from the fall of 2023 through March of this year was partly due to excitement over inflation falling with economic growth remaining strong, or, quote, a soft landing. But I think the market is now coming to grips with the fact that better economic conditions also means inflation likely sticks around longer than we thought it might, and the Fed keeps their target rate elevated longer than we thought they might. As you can now see in the CPI chart, we have now seen the headline rate stall out since about the middle of 2023, right around 3%. I think every time we get another higher than expected inflation report, the number of expected Federal Reserve rate cuts in 2024 drops further. As a result, in April, the market gave back some of the rally we had to start the year. The market may be disappointed that rate cuts have been pushed off, but I don't think we want to see the environment in which inflation is reduced significantly and the Fed feels the need to cut rates. That environment likely involves reduced economic growth and increased risk in the macroeconomy, with a possible recession. It's not such a bad scenario to oscillate between the fears of recession and the fears of inflation if we can stay in this happy medium of the two for the foreseeable future.
Sounds like you're saying be careful what you wish for. So let's switch gears a bit and hit on our favorite subject every 4 years, and that's the upcoming presidential election. How does that play into the outlook?
Sure. Of course, the election's on the mind of investors these days. The stock market's relatively strong start to the year has been accompanied by a low level of volatility, and an investor is correct in worrying that there may be volatility around the election. History has shown that this is the case, and that the VIX, or the CBOE Volatility Index, can spike around presidential elections. However, that volatility has historically subsided rather quickly, back to average levels once the election season is over and uncertainty is reduced. As can be seen in the chart on the screen, when thinking from a longer-term perspective, the U.S. stock market has continued its ascent regardless of the party in the White House. Looking at the past 30 years, the S&P 500 has averaged 10.4% annualized per year through the end of February, despite many different presidents over that time frame. For example, the S&P 500 grew 16.3% annualized during the Obama administration and 16% during the Trump administration, which are both higher than the average of the last 30 years. Investors who may have been guided by political opinions rather than a long-term plan might have missed those above average returns. And listen, we know that government policies on taxation, regulation, and stimulus can have strong impacts on the macroeconomy and therefore the stock market. However, we do not think the composition of governments or political parties in power alone warrants any deviation from a long-term investment plan.
Well, thanks, Jeff. And I couldn't agree more on that last point that you just made. And that's why our focus as a trusted wealth advisor to our clients is not on trying to predict the election or even the economy for that matter, but rather on ensuring that your investment portfolio is well aligned with your long-term goals, and that together we maintain the patience and fortitude required to stick with the plan through the inevitable ups and downs of the economy and markets. As always, we're grateful for the opportunity to partner with you in this important aspect of your life, and we would encourage you to reach out to your wealth advisor at any time to discuss your portfolio in more detail. Thanks so much for listening, and we'll see you next time.